This is episode 258 of the Andrew Hines Real Estate Investing Podcast. And now a word from our sponsor, Control and Compound.
Here's how infinite banking works in under 60 seconds. You have to save your money somewhere. Well, we think the best place to save it is inside a cash value life insurance policy. You save some money in there, it grows tax-free for the rest of your life. Then an opportunity or emergency comes along. Let's say a few years down the road, you can buy a business, buy a property, buy an income-producing asset. You leverage the infinite banking policy, borrow against your asset, take advantage of the opportunity. But your money still stays in the infinite banking policy. You're not borrowing your money, you're borrowing the insurance company's money. So your money's in the policy, it's in the opportunity, and it's providing a death benefit. Rinse and repeat, rinse and repeat. You get to retirement, and you have this massive cash value life insurance, leverage that tax-free, and you don't repay those loans. You sit on the beach and you spend that money tax-free every month. Doesn't show up on a tax return, and you leave your family a huge tax-free death benefit.
For more information, visit www.controlandcompound.com/Andrew Hines. Welcome back to the show. Today I have Erwin Szeto and Andrew Kim on. Erwin's been on the show many times before, so if you're curious about his journey, please check out some of the other episodes, because on this episode, we really focused in on what Andrew Kim is doing in his company. He's a very accomplished real estate investor who's established over $10,000 a month in monthly cash flow, which we didn't even get into in this episode. We more sort of talked about the U.S. strategy, why do it, what Andrew's doing in the U.S. as his asset manager business that he runs, and kind of dug deep on that. And this all really stemmed from, I bumped into Erwin at Costco one day, and he mentioned to me that he didn't think people should be buying in Ontario anymore, which I thought was a pretty dramatic shift for him, because he had been exclusively Ontario for so long and really not interested when I was talking to him about the US stuff. I mean, of course, interested as a curious person, but not really interested in doing it for himself. And then all of a sudden something switched for him. And obviously it's similar to what switches for a lot of other people, not liking the landlord-tenant laws in Ontario, the value's not working, the numbers not working, and kind of looking for a solution, going to a different place. So Erwin's hot on the US. He partnered up with Andrew Kim and wanted to bring him on the show to kind of share his story. So the two of them came on, we had a discussion, and this is one of those more passive investing type of plays. So a lot of times, like, passive investing is things like investing in private mortgages or private REITs or other private equity funds, where you're not directly owning real estate, but you're sort of indirectly owning real estate sometimes, depending on what you're invested in. But in this case with Andrew Kim, that is, he actually acts as an asset manager. They work with property managers throughout the US, and they basically help people get into cash flowing, turnkey sort of passive investments. And if there are renovations to be done, they sort of manage that through the property managers. So it's kind of unique, because you get an opportunity to be more hands-off than I think I've ever really heard of as a real estate investor. Now, this is in theory. I can't, say it works out in practice that way. It sounds nice. Returns aren't astronomical by any means, but there's a lot of potential for growth, and we work through some of those numbers. I think there is a good potential to get into the high teens while owning real estate. And then, of course, depending on what you believe will happen with appreciation long term, it could be much more than that. Obviously, that's the nature of investing, is there's certain things that we just can't know. So with that said, I think you're going to enjoy this episode, and it certainly is a different flavor. Just before we get in, as always, it's a new year, and I want to ask you to please take a moment and show some love to the podcast. If you haven't already reviewed it, please just take a moment, pause, and give us a 5-star on Apple Podcasts, 5-star on Spotify if you listen there. Just help the podcast grow more. I've got a very niche following on this show. And it's kind of tough times with real estate investors, so there is a little bit of a shift in the amount of interest, and I want to keep it growing. And if you're enjoying this show, I ask you, please support me in that way. It'd be greatly appreciated. So with that said, let's jump right into the episode. I will see you on the other side. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I've got many-time repeat guest Erwin Szeto on, as well as Andrew Kim.
Hello.
We're just meeting for the first time. So
yes.
Thanks for coming over. All right, so this is a different episode. We don't do a ton of the two people episodes, but it's always fun when we do.
You just had our first threesome today online.
We might have to retire that expression.
Andrew Hines and John Schwenker were on my podcast virtually for the first time. So it's the first time I had two guests.
Erwin's first two guest episode. We'll say it that way.
Two in one day.
Yeah. Yeah, it's a busy content day for me. So, but anyways, yeah. So it's good to have you guys here. My understanding is that we're going to be talking about U.S. investing under an asset management company. So a little bit of a different approach. In my initial assessment from talking to you, Erwin, this is sort of the more passive play of owning individual properties. You still get to own the properties, but you're a lot more hands off, a lot more turnkey.
Yeah, definitely.
So, Andrew, why don't you just tell me a bit about yourself, because you've obviously not been on the podcast before. I haven't heard your story.
Sure. Yeah. You know, I actually don't formally introduce myself as a real estate investor. I'm more of a tech entrepreneur, but I've always known that real estate was very much a stable passive asset class. So professionally, been in the tech space, building technology companies, built and sold my last one in the Valley. And
Silicon Valley.
Silicon Valley.
Valley,
yes.
okay.
Silicon Valley. And then, Share is my next technology company in the real estate space. But I got into real estate investing back in 2010, Ontario, Barrie and Ajax. And then when I moved to California and got introduced to the U.S. single family rental market, that's when I vacated Ontario, and we can go into deeper details later, and started investing in the U.S. And then have kind of grown slowly my portfolio over the years. So Share is the intersection of my passion of technology and real estate.
Yeah. So we'll talk to you a little bit about your specific real estate investments. Like what type of stuff? So you said you were buying stuff here in Ontario? Yeah,
I was trying to chase that BRRRR model back in 2010, late 2010, when you could get a house in Barrie for like 200, 1,000 or under, and then Ajax around the same, just a bit more. Around that time, beatings up like foreclosures, a lot of heavy lifting. And then I thought I was okay at it, but then turned out to my accountant that I wasn't that great at getting cash flow. And that's kind of my foray into it. And then in the U.S. single family as well.
Okay. So just single family homes you've been buying down there, and they do cash flow, but not as much as you wanted, or it was working and you wanted to scale that?
So it was kind of working, but like I was self-managing them, and I was, that this was supposed to be passive for me. And it was taking a lot of time and effort, especially if I'm like on the west side and then I got to go to Ajax or Barrie for any issues or find contractors. It's kind of tough. And I really didn't have the tools necessary. I was kind of going in there blind. When I get into something, I just kind of go full steam ahead, and realized I made a lot of mistakes. Could have spoke to more people about how to go about doing things. And I ended up netting out some cash when I sold them. But on the cash flow side, it was probably a bit negative every single month.
Yeah. Okay. So what are you doing now from a real estate investment standpoint? Is it just Share, like the model with asset management, or are you doing your own personal stuff as well?
All my personal stuff now comes through Share.
Okay.
I originally, when I first moved to California, like 2011, started buying in St. Petersburg, Florida.
Okay.
That point, you could get something in a single attached around 90,000 to 110,000.
The glory days that I should have been buying in Florida. I know another guy who started buying right around then and just like changed his whole life. He was a financial planner here, moved down there, just started buying up everything 10 cents on the dollar.
Like if I would have just said, just deploy more, do more then, that would have completely changed the trajectory of my life for sure.
Yeah, it's crazy. Like the lesson that I should have learned more, deeply ingrained is the effect of credit on real estate. How much of a difference it makes.
Yeah.
Yeah. What an opportunity that was. I don't know if we'll ever see an opportunity like that one.
Yeah.
And the dollar was near par
around
the time when you started.
Yeah, exactly. Yeah.
Fucker.
Yeah. And, I kind of feel like that's the sentiment in general now. It's like you're always like, now is going to be the cheapest time to buy potentially for the next 10, 20 year outlook. Like in 20 years, 10, 20 years, you're going to be looking back and be like, I should have bought more.
Yeah. Well, we were talking about off camera, do we think we're at the bottom? And like, there's certainly arguments for that.
Yeah.
But the more people talk about the interest rates coming down, they kind of push the prices back up and make it less likely that the interest rates come down.
Yeah. It's interesting. I think like the higher price point homes for sure, the bottom, there's still a more likelihood that the bottom could go lower. for higher price point homes. And I speak in generally like in the US side, like the major cities where you're like New York, San Francisco, LA, which more like 2x the national average. I feel like there's still an opportunity for prices to drop there, right? Whereas the investment asset class, which is at or below that national average, they're a lot more resilient because you typically can get an owner occupant and then like a retail investor or an institutional investor. So it kind of holds the price points pretty strong.
So so Andrew, it's funny because he says he doesn't consider himself a real estate investor, but because I know Andrew, he's more successful real estate investor than most people I know. I mean, he did as a side hustle, truly passive. Hasn't seen any of his properties.
Well, and we're gonna get into that. So that's a good segue because Erwin, I don't mean to neglect you here.
That's okay.
Sitting over there wearing your USA jersey. So I'm gonna give before you do. So I've known you for I don't know quite a few years. First we met in like 2019, I think. So you came on my podcast then, and I've known you to be a guy that you're fully into what you're doing and you're very enthusiastic about it. So I've talked to you about the U.S. many times, and that's interesting. And then one day I see you in Costco. So I don't think anybody should be investing in Ontario right now.
Is that what it is?
I'm like, something's changed with Erwin. And sure enough, you're all in on the U.S. And I think that that's interesting to say the least. So why don't you tell me about that? First off, give a little bit of a background, what you do, your story in real estate. You're a podcast host, just for people who haven't heard the other episodes.
Okay, so I've been a landlord since 2005. I've owned over 40 properties personally. I'm a realtor as well, so we've had over 350 clients. My team has transacted on over $440 million worth of income properties. Done a lot. I've hosted 2 major conferences.
Yeah, you hosted Grant Cardone. That was cool.
I've hosted Grant Cardone. Mm-hmm. That was pretty cool. Podcast is usually second to yours.
It's a great podcast. Yeah.
Thank you. I get great guests like yourself on my show. And I currently own 10 properties in Ontario, and I'm kind of sick and tired of it. Actually, a friend of mine said the analogy he used was he's been feeling Ontario's been in its 9th inning of real estate for a long time. Mm-hmm. I thought, oh wow, that's a good way to put it, and that's kind of how I feel as well. But I'll just add to that though is that all these things are being stacked against us as well as Ontario landlords. Mm-hmm. The LTB, because even before the pandemic, LTB was still... It
was bad.
It was still bad.
It just really emphasized how bad it was, right?
Yeah, but hang on. It was still 3 to 4 months to get a hearing. Versus, Andrew, what's your experience? If a tenant's vindictive, not purposely doesn't pay rent, what is your experience?
From when we're going to act to say, okay, we've got to replace this tenant, 90 days we'll probably have a new tenant in.
Oh yeah, south of the border.
Yeah. Yes.
Yeah, north of the border. I mean, I've heard recent stories of a year like that. That's very common. You could have somebody.
That scares me.
You could have somebody keep you a full year without rent.
That's your asset. That's your investment.
Imagine you were one of those investors who just wanted to dip their toe in. You buy your single rental property with your life savings from work. You have break even cash flow on that property, but it works while it breaks even. And then all of a sudden that disappears, and now you're carrying 2 mortgages on the same income from your job. Like for some people that will end them. Like they'll go bankrupt. Now of course, you hope that they can sell the place and whatever. But that is scary. Like it's
like, I'm going to invest in RSP, but we're not going to actually give you full control over when you can look like.
Yeah, I mean it's nonsense, and I was just talking to Erwin about this on his podcast. But I mean, you have to get a risk premium to deal with that. Mm-hmm. Like, so that's the way I look at Ontario. I'll do a deal here, but I need a risk premium to do that. A good one.
Right.
The thing is, I think I can get the same upside in terms of appreciation, equity gains in the States. But, I was looking at San Antonio, for example. I can buy 1,000 square foot detached home for $200,000.
Yeah.
And what would a single family home rent for in San Antonio?
Well, at the 2,000 range, you're probably looking around 1,500 to 1,800.
Getting closer to the 1% rule.
Yeah.
And a single family home. So it's plus utilities.
Utilities. So they pay their own utilities.
And it's vanilla lending.
Yeah. Mm-hmm. Yeah, exactly.
Versus, to get anywhere near that, I need to do student rental here, or I need to go like triplex conversion.
Like how's that look? Is that cash flowing for like a Canadian to go and buy something like that through your asset management company?
Yeah, so there's so many different capital stacks that Canadians are using, like different vehicles. Some are using cash and HELOC and
Yeah.
TEP. But if you're going to come in with the traditional investor loan that we would find you, you'd probably come in with your 30 to 35%.
35% down.
Yeah.
Yeah.
And that's typically like the first time requirement as a foreign national is a bit of a higher down payment.
Okay.
Yeah. So that's common. And then, you'd probably get some cash flow positive.
Okay.
Yeah. Self-funding the renovations too.
You got to self-fund the renovations and then refi after, or no burr?
We would do the refi in probably 2 to 3 year time.
Oh, okay.
Yeah. The appraisals are a bit tight.
So you as the asset manager, would you head that process up?
Yeah. So we follow your interest rates. We'll know what you kind of debt stack you came in with. And then now we're modeling most of our clients for 3-year refi.
Yeah, I like that terminology. You only hear serious real estate people use the debt stack terminology. I don't even use that.
I didn't until I met my business partner. He's an institution guy.
What's our debt stack look like? All right, so let's run an example. So give me a middle of the road property that you have access to right now.
Okay, so let's call it a Memphis, Tennessee, 150K home.
Okay, 150. Okay, and what would something like that get in rent?
Around 1,400.
1,400. Okay. Ballpark property taxes for something like that?
Oh, that one, taxes. I'm still turned around on taxes. But I would say I could probably back into the cap rate if you guys are using cap rate.
Yeah, sure. We can. Okay, what do we
like? That would be a 7% cap rate.
7%.
Yeah.
In a single family home.
Yeah.
Let's just put a number in here.
So that's like 1,050.
For high level though, there's no state tax, so the property tax is typically higher. Just when people go back and look at the numbers, it's different. And when I say no state tax, I mean no state income tax.
Mm-hmm.
Versus here in Canada, we're in Ontario right now. We pay an income tax to Ontario. We pay one to the federal government as well.
So to get a 7% cap rate, you'd be looking at about a 35% expense ratio on operating expenses.
Sounds about right.
Sounds about right. Okay. So that would include, for anybody following along, your insurance, your property taxes, no heat or anything because they're going to pay that themselves.
Utilities are usually tenant.
Yeah, so really
probably limited heat. We're talking about Memphis, Tennessee.
Yeah, they didn't really need much.
More air conditioning.
Any other expenses they would have? Like they're going to have a property management.
Yeah, the PM is rolled.
So
in
then
there.
that's all in that 35%. The PM
typically.
and asset management's covered in that.
Like cap rate is typically
pre-asset management. Yeah, because that's not related.
Yeah,
to
but the PM is in there.
Included that. Okay, so then you said we're going to get typically 65% loan to value on a first mortgage with what kind of amortization?
30-year fixed.
30-year fixed. What kind of interest rate these days?
Right now, probably high 7s, around like 8 if you want to kind of be real.
All right, we'll be conservative. Yeah. Okay, so at 8%, that's a $700 payment. So there's like $170 cash flow left over.
Yeah, sounds about right.
Yeah.
$700 though. I want to put that on my credit card so I get the points.
$700. Oh, the mortgage payment?
Yeah.
I mean, that is like compared to mortgage payments in Ontario these days, it seems quite low.
Mm-hmm.
Looking at that number, I mean, obviously it's a much lower investment. So somebody to do that deal is going to need to come in with about like 50 some odd.
North of 50.
Yeah, like 55,000-ish. Yeah. And that covers it because there's a fee for you guys to find the property, right?
Yeah, so we take 3% or $7,500, the greater of the two.
So you find the property that'll work. That's basically, and then and you already have a property manager that can do it. And so where do we build in? So out of that $171, is your fee gonna eat up the rest?
It's gonna eat up a chunk of it. Yep, for sure.
What's your typical fee for this?
Probably anywhere from 0.25% of the house price to 0.5%.
On
150.
Like so, one time on that
annually.
Oh, okay. So just whatever the price is worth.
Yeah.
Is it always based on what it was purchased at, or is it?
It'll be purchase plus reno.
Yeah. Purchase plus reno. So on this one at 150, it needs a reno as well.
Yeah. So you'll probably look at on that case, we'll just loosely say like 10 grand.
10 grand. So you got 10 grand on top. So then you're looking at more like 60, I guess, after the reno, 65.
Yep.
Somewhere in there. So at 65 in, let's see here. I'm just going to put in the total investment, 65,000. Okay, so now the question is, like, what do you figure, like, we're obviously questioning, are we at the bottom? What do we expect real estate to do in the longer run? I mean, is it safe to go back to thinking 2% over the long run on an annual basis?
That's where we kind of mark the 150K homes at like 2%.
Yeah, you figure 2% a year. Yeah, I mean, there's money there. It's not huge.
Yeah.
Is there other ways to kind of win on that?
Well, like what we're gonna do is like pretty much unlock that on the refi. So we'll still recoup like 60% of your down payment at the time of refi.
Okay.
And then
so you think the 10 grand that you put in there, that forced appreciation, is actually better than just adding 10 grand in value?
Yeah. So like we'll get, and like, again, this is a higher than normal down payment just to get it to cash flow positive.
Yeah.
So once we go on refi, we'll probably recoup like 30% of that roughly.
In that you've
Or
been
30.
have you been doing that predictably over the last couple of years?
Yeah, pretty much.
So if they're in for 65, they might get 30 back.
Yeah, probably.
And then be down to 35. So if you come back down to 35,000, then it starts to look like a 17% return on the money
and then
in.
the cash flow still ticks up every single year because
you're expecting rents to keep going up. So yeah, that my spreadsheet doesn't yet build that in. I could build a more sophisticated spreadsheet to add that in. But yeah, so you're going to have an increasing. So once you get up to like say $1,500 a month, then you're going to be a couple $100 a month in cash flow. 260 I got here, and
the number goes up because rents go up.
Yeah.
Over time you'd expect the rents to go up. I mean, it's interesting because the U.S. they don't immigrate people like we do here.
You get a lot of immigration.
You get in-migration to certain areas, and then you get, of course, illegal immigration. The legal immigration,
what they can track.
What they can track. Is it even possible for like illegals to end up renting, or not really? Because they wouldn't pass the
unless they've got legal papers.
Yeah, they'd have to.
There's a lot of tools and background check options for landlords over there.
Yeah. So what do you think? Like,
oh, sorry, Andrew. Just before I move on from numbers, like when I'm running numbers, like 5 year, for example, my cash on cash returns are like over 5%. Even
in a
after
5 year?
Yeah.
Because I had the cash on cash just around 3.5, but obviously not including rent increases, not including getting that money back. Like once you get that money back, it's going to improve it significantly. Then I got cash on cash almost 10.
Yeah.
Like once you get to the refi point,
which is better than any bank stock.
Yeah. So I think the big thing here is like most people don't have any time to do that kind of thing.
Yeah.
That's why it's supposed to be a passive investment. So you're obviously going after the people who want something a little bit more hands off.
Yeah, that's exactly it. Like our clients are high strung, pretty busy professionals that literally like it's a very specific profile. They have zero time, but they've got cash.
And that's a great profile to work with.
Yeah.
Because they're gonna let the expert do the work, right?
Yeah.
So you guys kind of bring that unique value proposition in that you're going to go down there and do it all. Like you're going to even arrange the refi, which I mean, typically I don't think almost anybody's used to that kind of service. Not unless you're invested into a REIT or something.
Right.
Where they do all that kind of thing.
Yeah, exactly. Yeah.
That's the beauty of share.
Yeah.
You're basically investing into a REIT.
But you're directly owning.
You're directly owning and share's not taking a percentage.
Yeah.
So this is a lot like the joint venture model, except these guys are have way more experience and background.
Mm-hmm.
And again, they're not going to take a percentage.
Yep.
Yeah, I'm just going to calculate. So I forgot to do this number earlier. So if it was 150 acquisition, or say 160 including reno, that'd be $4,000 a year in asset management fee. Does that sound right?
That's way too high.
Did I do that wrong?
It's around 0.5%.
Oh yeah, I did. Yeah, okay. $400 a year.
Yeah.
Yeah, okay. So what's that work out on a monthly basis? That's $33 a month. So it's not huge. It's not going to rob the cash flow.
Yeah.
You still have your cash flow. So it's not a huge cash flow, but I think that, people in the demographic you're describing, like they probably don't need a ton of cash flow, but they want something to be growing as an investment.
Like those would be what we classify as like a cash flow heavy home.
Okay.
But yeah, we all know that in this higher interest rate environment, it's
tougher.
Definitely tight. But we're all saying if it can we can make it cash flow positive today, then
if bond rates keep coming down, if rates keep coming down, then that'll allow you to potentially refi.
Exactly.
And then you can lock it in for 30 years.
The 30-year hedge is incredible, right? Because at very least your interest rate's not going up.
Yeah.
Like yes, the market interest rates could go up, but if anything, that's a good thing for you because that's just going to drive rents up.
Yeah, exactly.
Yeah. So if they come down, then you'll refi and lock in. So this is one of the best things about investing in the U.S. compared to Canada is like in Canada, every 5 years you've got an opportunity to lose your home.
Right.
Depending on what happens, the interest rates in the market, right?
Yeah.
And also a prediction, and not that I like to make these predictions, but I think that if you had to pick one of the markets to have room to fall still, it would be the Canadian market because of the mortgage renewals, because 25% of those mortgages renew every year into higher rates, causes people to consider listing their property, causes inventory to spike. The offsetting factor, of course, in Ontario is the immigration.
Right.
So who knows where we land? That's why I always just talk in circles of what could happen.
Yeah.
The competing forces.
Yeah, and you know, Pierre Poilievre came out with his detonation video just last week. Not everyone's seen it. It's already gone viral. Like,
really?
Yeah, I'm sure he's gotten 1 million views across his platforms. And that got me thinking again, because I've been worrying about this for a while, is, you know, the Americans have had their financial crisis of 2007 to 2010.
Yeah.
We never had it.
No, we didn't really. And now Canadians look a lot more similar to what Americans look like then, with the household debt and all that. So, yeah, who knows?
Yeah.
Like, it's really tough to know. Again, like, there's just that wild card is the immigration side of things. If we didn't have that, we would already
We'd be done.
We'd be cooked.
Yeah.
So that's the factor that could actually still just push values right back up. It could still happen, and you know that would basically just effectively remove investors from the market, because why are they going to do it? And except for your larger institutions that can afford it and they don't mind. They're looking way long term,
right?
And know it makes sense. I don't know. So what are your thoughts on the U.S. market? Like, what areas do you like? What areas don't you like? What are you looking for, and what services are you offering? I know that's multi-part, so we start with the first.
Yeah. So what areas? So we typically go around the Sun Belt, so all the sort of southern states across from east to west coast. Typically they're, you know, red states, landlord-friendly states, tax-friendly states, and then some of the Midwest, Kansas, Missouri, Ohio, those types of regions.
Yeah.
We see, you know, there's a lot. Unlike in the U.S., there's a lot of institutions in the single-family rental space, and you know, we're using a lot of the same data points and research that they're using. Again, there's a lot of population, market growth, economic growth, and we follow those types of trends. The ones we're kind of tiptoeing around now are Nevada, Arizona, and Florida for different reasons. So Nevada, Arizona, they have had a bit of a price adjustment. So just tiptoeing around them. But in a good market, we would be all in on those two states. And then Florida for the fact that we can't predict their insurance rates in the next like 3 to 5 years.
Yeah.
So that's a big, huge variable for us to be able to underwrite.
Yeah. And what's your own experience with insurance?
You love bringing up my insurance rates. So
because people love numbers. Like,
yeah,
Andrew, your listeners like numbers, don't
know.
they?
Yeah, they do. So we are active in Florida, and if clients want us to find in Florida, we'll go ahead. But my personal insurance rates have gone up for some of my homes around 70% this year on the new rates.
Yeah, is that the flood insurance portion, or is that the?
So all sort of levels have lifted. So the way some of our insurance provide categorize, they have like different tiers of risk. And for the longest time, it was just a tier 1 risk that was ticking upwards. But now all the rest of them have jumped up 70%. So they've now come closer, and the gap between tier 1 and tier 3 and 5 really tightened.
Because would your St. Petersburg properties be lumped in with around Tampa?
Yeah,
Tampa
so it goes a lower risk. Yeah, so that is where we saw a 70% lift.
So wait, so historically Tampa's been considered low risk, and now it's being lumped into high risk?
Well, it's not that it's lumped; it just the rates have now caught up.
So the rates the same as high risk.
Yeah, they're catching up.
Oh mercy! It sounds like there's no hiding.
Well, I had like one quarter on like, because the houses before they sold, I had to insure them myself after the construction was done, and you know, anywhere from $2,000 to $3,000 per quarter, not including flood. There's no flood policy for that. Like, that's not including natural disaster. That was just the insurance portion.
Right.
So you had to buy flood insurance separate, but we were out of the 100-year floodplain we actually literally built up and built out of it. So didn't take that endorsement, but yeah, it can be ugly. I have heard of people having grandfathered policies there that are quite cheap still. I don't know how that works, but yeah.
I can't imagine that if things go in the direction they're going, that whoever's offering that will probably have to
stop.
Yeah.
Yeah, that hurricane there in Cape Coral hurt things. My properties were okay, but I mean, I think my insurance rate took a hit over it.
I feel like it's very relative. Like for people who live there, they're just, yeah, it's okay. You know,
Just
like I
part
got a
of
new
it.
roof.
Yeah,
great.
it's just part of it.
Yeah.
They're used to it, right? That was a very odd hurricane, though, the
Yeah.
way it came in and, you know, turned directions. It doesn't really happen very
Yeah.
often. So once in 500 years, they said for Cape Coral, you know, how it hit there.
Yeah.
Like we were right in the eye of the storm with that.
wow.
So
Yeah,
Just my
it's just
luck.
harder for us because
Yeah.
like we try to give you that institutional
no,
grade.
and it
asset
does make it
management.
tough. Like, so do you
Yeah.
need to? I don't really think Florida makes that much sense for a long-term rental anyway.
Mhm.
It's more of a short-term rental market. It commands short-term rental pricing, especially if you get down into Naples and stuff. You're going to pay big dollars, but you're going to make huge money on those
Mhm.
properties. But I think there's a lot of other states. Like, give me an example. So Tennessee, you would be in like
So the other ones that we're really bullish on: Texas, Georgia, Carolinas, Tennessee.
Carolinas are blue though, aren't they?
I
Maybe
think they're
purple.
Purple. Yeah, maybe purple.
Yeah,
But like
yeah.
I still think that like even
Yeah.
the blue states are still better.
they're
off
better than Ontario.
yeah, they're still
Like-
better than Ontario.
You're
I
still
mean, I've
staying
heard-
out of New York City and
yeah,
California.
you
Yeah.
stay out of
Yeah.
New York, the cities, right? Like I've
Yeah.
heard that New York State is not bad. Like,
Yeah.
I know people that have.
I've
visited.
He owns it.
I've got property in upstate New York.
Yeah.
Yeah,
That he's
so-
never seen before.
Yeah,
Landlord-tenant issues? No.
no, definitely
Yeah.
not.
I bet you're still like way better than Ontario. For
Yeah,
for
100%,
treatment.
100%. Like whenever there's an eviction,
Yeah.
it happens.
Ohio's the one people sing praises of because it's like so quick to evict there.
Yeah.
Same with Florida, very quick to evict.
Yeah, like we look at Ohio as like sort of your cash flow friendly states.
Mhm.
But the hotter states like the Texas, Georgia, like the Sun Belts, we like those because the appreciation value as
Yeah.
well.
Oh yeah, you're not really going to get the appreciation in Ohio, right?
Yeah, we mark those up at like a 2% sort of modest appreciation, whereas some like parts of Atlanta and some parts of like Dallas, you're getting like GTA type or Greater Toronto Area type appreciation.
Like still now?
Well, in historically, yes.
Yeah. Hi, friends. I just wanted to take a moment away from the episode to tell you about my brand new structured coaching program. This is the first time I've ever offered a structured coaching program where we'll have regular meetings in addition to an intro call to go through what your goals are and help you get on a plan to achieve those goals within real estate. So if you've followed me for some time and you feel that I would be a fit for you to help you achieve your goals in real estate based on my skill set, based on the topics we cover on this show, I encourage you to head over to my website, andrew-hines.com/coaching, and fill out the questionnaire so that we can schedule a call and figure out if it's a fit for us to work together. Let's face it, most people could benefit from a second set of eyes and ears going over their strategies, different deals that they're looking at, and helping to springboard ideas back and forth. This is a program that's exactly for that. So if you're looking to build confidence in what you're doing in real estate investing and get very clear on what it is you're trying to accomplish, this might just be the program for you. Take a moment, fill out that questionnaire, and let's schedule a chat. Okay, so yeah, Ohio is a higher cash flow state. That makes sense. I've got some experience in Ohio, and I know like that's what draws people there.
Mhm.
What do you look for when you're picking like a city, a state? I mean, obviously you're looking at landlord friendly. So let's say you've picked some states that you think work.
Yeah.
Now, what are the macroeconomic indicators that make you like that market? Things you want to avoid? Tell me about it.
Yeah, so we typically look like we pretty much know which metros to look at because again, the job growth is always ticking upwards, employment, population, price points. That's one of the reasons why I think we kind of got out of Nevada and Florida is the price points were going up so aggressively that
outpacing job growth.
and then you got some cap rate compression there because of that.
So are there key metrics? Like, is there a rule of thumb, so to speak?
So like you would just kind of back into sort of average rent rate and price point. So we do we've kind of outlined a metro and then we go into a zip code level when we find a deal.
Right.
So we have like filters running and as they come in, we'll look at a zip code level, what type of average household income, price point, unemployment, all of those types of micro details. And at the end of the day, if we don't feel comfortable about what the rental rate will be in that specific zip code, and that ensure that the household income is kind of ticking up to the right, then we will kind of shy away.
So is there a job growth number, say for instance, like a percentage growth rate that you're looking for?
Yeah, there typically is, and it looks probably as in terms of in relation to population growth as well. But that is the area of my business partner, the head of investments.
okay.
He looks at all of that, has his industry sort of best practices.
Yeah. Oh,
And,
I'd love to hear him.
Yeah.
Lay it all
We
out.
maybe a little book him for this show.
Yeah.
Like for example, Dimitri,
Like,
you're talking about him and I were talking about Austin, Texas, for example. So some basic stats on Austin is, I believe it's growing twice as fast as the state average of Texas, and 4 times the national average in terms of population. Right, and that's a period of 2010 to 2020. So that's even
So is
before
the
the pandemic.
population growth is outpacing the real estate value growth?
Like that will, like, I think each one in relation to each other
Yeah.
is sort of the different profile of home
Yeah.
we go after, whether it's appreciation or cash flow.
Yeah.
So he could give you sort of the lay of the lands of the different dials he'd look at for dialing up and down.
Yeah, you're gonna get. I mean, I would think you're gonna get more appreciation. I actually had a guy who's just like a analytics data guy come on, and he talked about some of the metrics, and some of them are a little foggy for me. That's why I was asking. Maybe you could refresh me, but for sure, I know that job growth is a big one. I'm sure if that's outpacing immigration, that's going to be a positive.
Yeah.
There's going to be several other things where you could just reason your way through. Oh, that's going to have a good effect in the long run.
Yeah, like population and job growth are typically the 2 top ones. Like in general, if you want to like take a very loose approach, the thing is about the job data, it's like becoming harder to analyze because the people are working remotely, moving inland. They could be living in Austin, but working for a company out of Silicon Valley. So that one's becoming a bit of a different pace. So now that you roll in household income, and that sort of changes the land.
Yeah. So are you saying that you have to rely more on household income as a metric?
You want to look at all of it.
Yeah, you want to
in
look at it
relation.
all.
Yeah.
Yeah.
But before data was like readily available.
Yeah.
The way it is right now in the U.S. But the 2 safe ones were job and population.
What do you look for as like a red flag for an area?
Rent control.
Rent control will be a part. Is that even a thing outside of the major cities like New York?
Not really. I mean, if there is, it's like you can't raise it above like 10 or 15%.
Yeah, it's reasonable.
Yes.
Okay.
Yeah.
Yeah.
For me, red flags are, downward population.
Yeah. So like a Cleveland.
Yeah.
Is
I don't know if Cleveland is, but yeah, like there are certain parts of like upstate New York that are certain ticking downwards, but the demand for rental is still there, shockingly. So
well, that's the risky game, right? If you go and buy at those markets, like you almost have to just expect that you're making your money from the cash flow, and that one day you're going to sell the asset
100%.
at a major loss.
Yeah, 100%.
Yeah.
Or like the exact same price you bought it 10 years later.
Yeah.
At
Well,
most.
I bought one in Youngstown. One of them I had to give away because it got destroyed, but the other one, these were cheaper properties, like around 15 grand or whatever. But the one of them after title fees and all that, I mean, I think I made $7,700 off of it. Paid $15,000.
I've never dipped out my toe there yet. I think my cheapest one was like 45,000.
You know what? Like you could do Youngstown well, but you need a full out business to really operate there because it's like a wasteland.
Right.
No offense to anyone from Youngstown. I mean, it's got some nice parts to it, but it also has some serious problems.
Yeah.
It's tough. So typically probably avoiding places like that.
Yeah, we say there's a time and place for every type of real estate, but definitely if you're trying to dip your toe, if you're a beginner, do not go into those areas.
You could make money in those places, but you got to have a really honed in strategy.
Those are like for rounding up your change, right? Your cash flow that you've accumulated and you kind of forgot that was there. It's like, okay, let's go deploy that.
Yeah.
For my own investing though, I prefer as little risk as possible. Like I want, like for example, I don't gamble. And if I do take a bet with someone, I want everything in my favor.
Yeah.
So I know we're talking about Ohio, but for example, like demographically, Americans are generally moving south.
Yeah.
Right. Just for the weather. I think we'd all, as Canadians, I think we'd all take that option if we could.
Be south. Yeah.
Yep.
Right. So for example, when I was looking at Columbus, Ohio for investment versus like Phoenix, Arizona, I use those as an examples because both of them are getting a semiconductor plant, a brand new one being built. Right.
Yeah.
The one in Arizona is Taiwan Semiconductor Manufacturing Corp. So that's going to be like 4,000 jobs, right? Phoenix, Arizona. Columbus is getting one from Intel, around 4,000 jobs as well.
Yeah.
So if you have the job skill to work at either plant,
yeah, you're going to want to go to Phoenix.
it's not even close. Not even close.
Except unless you're looking at like, what can I buy a property for in Columbus? And you say, oh, well, it's far more affordable. Maybe we can have a better lifestyle there. I don't disagree.
Right. From my early
Arizona's
research,
tough though.
for my early research, I think for a home that a pretty nice home is like low 300 for Columbus. And I think might have to pay 400 for that in Arizona.
Okay.
Right. So it's not
It's
a
not that much
massive
different.
delta.
Yeah.
Right. But again, I don't even have to go there. I can go to like Dallas, who's
Yeah.
getting a Texas Instruments plant.
Yeah.
Right. And I can probably buy a house for like $250.
Right.
Yeah. Yeah. Texas is the interesting one because the price points are still quite low relatively. Property taxes are quite high though.
Property taxes are real high. I mean, the price points are going up. We're not like, we would look at the probably 300 price point range in Dallas for class like B and A product. But we still think there's a lot of upside there. And the COVID just sort of drove that upwards. Everyone's moving out of, California. And
Yeah. A lot of people like flocked to the red states.
yeah.
Just to kind of get out. So
Yeah.
that obviously had an effect on those places.
Yeah.
And
But even like economic fundamentals are all there. The job growth and everything else is going. Like it was there prior to the COVID.
yeah, it makes sense that Texas Instruments would manufacture in Texas. Nice to hear that.
I think it's their third plant in Dallas that they're building.
Yeah. Yeah. I would have assumed that they would have
A strong
a
foothold.
plant in Taiwan or something.
yeah. By now.
Yeah.
Well, that's the funny thing. The Taiwan's company is building in Phoenix, Arizona.
Yeah, that's so interesting.
Yeah, that is interesting.
But it makes sense, right? You would want to diversify some geography away from China.
Yeah, onshore a little bit, just in case.
Yeah.
You never know what might be coming down the pike. So yeah, that makes a lot of sense. So to recap, we've talked about Texas, the Sun Belt in general. So you said Georgia, the Carolinas. What about like Virginia, West Virginia?
There are options. We don't typically look there. I remember Dimitri giving me a reason, but it escapes me now.
Those are bluer states as far as I can recall.
Yeah, I think for the most part, all of the ones on the Sun Belt are still rather like landlord friendly. And again, relation to Ontario.
Even if they're blue, like we said, like I'd still consider it.
Yeah.
What about getting into like Section 8 or anything like that? Have you guys looked at it?
So interesting. I got a very different perspective of Section 8 versus my head of investments, Dimitri. I own a handful of Section 8. I think you got to find the right ones, the right neighborhoods, and the right tenants, and the right partners that have deep expertise in Section 8.
Yeah.
Doing Section 8 yourself as a newcomer, don't even try.
So what's your team look like for that?
So you want a property management company that is absolutely solid and has like a good portfolio of Section 8
that's
tenants.
what they do.
Yeah, because then there's a lot of upkeep there and a lot of control levers of the program that they have to be on top of.
Yeah.
So just to kind of give you a Section 8 primer, there's a lot of the government gives them a coupon to which is essentially like a subsidy to pay the rent. They enlist their own tenants that have to apply for Section 8. So they do their own individual screening, but they also do the screening on the house. And they want to make sure the house is kept to a certain standard. So like from an owner, you're like, okay, this is great. I don't have to worry about the tenant because there's a third party and everyone's trying to get on that Section 8 list. So
they don't want to screw it up.
They don't want to screw it up. They want to stay in there. They want to stay long-term, hopefully.
Because they're basically getting free rent.
Yeah. But then
the average subsidy is about 70% of the rent,
70%,
which is enormous.
Yeah, it's massive. So those and it's almost like a self-governing system. But then you worry where Dimitri's counter argument is like from an appreciation and rent growth perspective, you can only be throttled. You could potentially be throttled by the Section 8 office, and then the appreciation potentially. Everyone invests in these neighborhoods with the hope that it'll come out of that sort of Section 8 classification and it'll become like the next Hamilton, I guess, right? Like that, you win the lottery. But if not, then the appreciation kind of gets stuck, and then the Section 8 person that you're working with gets out of control and says you have to fix this, and to stay part of the Section 8 program, and now your renovation budget or R&M budget just runs right through the roof.
Right. Okay.
Just trying to
This is
try
why
to stay
you
on
need
that
a
list.
good property manager that can vet that.
Yeah, and like they also have relationships with sort of those offices, so they can kind of give you the better underwriting and assessment of that particular Section 8 office. But
so is this through your company through?
I learned
asset management?
I learned prior on my own. Well, through a property management company that promoted Section 8.
Yeah.
But right now through Share, we don't like promote Section 8. We can do Section 8. We just because of our clients, now we're getting a lot of new clients, new investors, novice investors. We're saying kind of shy away from Section 8 for now. let's get you something more stable, something less risky. That way we don't sort of taint our relationship from the onset. And then
Yeah,
as you
because you don't
become
want
more,
them to have a bad experience.
yeah. And then,
Yeah.
as we grow this relationship and get you into a stronger appreciating asset, then, we'll round up. And we have to be mindful. Most of our investors come from the major metros of North America. So you're talking Toronto, New York, San Francisco. So they're accustomed to higher price points and they prefer safer investments.
Yeah. Well, there's a certain comfort to investing in something that's so low price to get into.
Yeah. And when you see pictures, you're like,
How is that possible?
Yeah. And oftentimes they'll be like, I wouldn't live there. It's like, well, this isn't an investment property, but yes, I totally get it. If you see some of these houses, you'll be like, okay, I don't want to be that owner. Right.
Yeah, that's fair.
Yeah.
Could you walk me through, you told me the states you're in. Like, how would it work if somebody wanted you guys to like asset manage and find them a deal? Like, what does that process look like?
Yeah. So a couple of, it's creating a free account on our site. We do an intake form on type of home, type of funding that you might need. And then we probably do 1 to 2 phone calls on identifying your buy box, which is essentially the profile of home, appreciation versus cash flow, price point, and then working your financing strategy. Are you using a cash, HELOC, or do you need us to help you get financing? We'll put all those numbers on paper for you. And then if you're comfortable with those types of returns on a 10-year basis in our strategy, then we start searching for you. We'll help you form your entity in the US. And then we turn on our search, which goes through on-market and off-market deals. So on-market being anything on the MLS, Realtor, Zillow. And then off-market, we work with a lot of institutions that are offloading portfolios or large wholesalers. And then when we see a match, we underwrite it, send it to a local agent and PM to double check it, put in a contingent offer. And then once that contingent offer comes back, we present it to the client. If they like what they see, then we send in a scope team to third-party inspection, renovation team, and our PM, tighten up all the numbers and assumptions, change our pro forma to be as accurate as possible. And if they like it, then we go to like a 30 to 45-day closing period.
Okay. And like you're always here in Canada, like you have a US team that's doing all that?
Yeah, like my CFO, she spends 60+% of her time in the US. But for the most part, we are a Canadian team. Just professionally, we've all been in the US real estate market. And we're physically here. Myself and my head of investments, we go back and forth, but all of our sort of operating contractors are all sort of dispersed throughout the States.
Okay. So you're obviously like, if somebody signs up for that, you're only circulating them offers or options that are within the areas you're already established.
Yes.
You already have the connections with the property management. So everything that is it like they're dealing with somebody in your Canadian team the whole time, or there's somebody in the US?
Just us, our Canadian team. But like the partners we have, they're huge. They're like multi-state operations, typically.
Property managers?
Yeah, tens of thousands of doors.
So you've got easy expansion with them.
Yes, yeah. So, they're, I think, at least in 5 states minimum.
Yeah.
And yeah, they only service large institutions.
And what kind of rates, like property management rates?
Yeah, so anywhere from 5 to 8% of gross rents. Yeah. And they're like, I try to express this a lot, but they're like, again, they're for institutions. They wouldn't take like walk off the street 1 or 2 homes.
Yeah, especially for like a single home or something like that. Yeah, they're not going to like that much. Okay, so they just know they deal with you guys. So they basically just deal with you, the asset manager.
Yeah.
So the rents all go to you, and then you guys distribute the rents to the owners.
Pass through that.
So that's
savings and
that's
quality.
why they're willing to do that. Otherwise, if they had to deal with all the different investors, they probably wouldn't be keen.
Yeah, like we're probably the smallest client on their list, whereas their next biggest client has like 50,000 homes with them.
How many homes do you have with them?
We have, depending on which regions we have, as little as 40.
Oh, like in one region?
Yeah.
Okay. So what do you have all throughout the U.S. right now?
Well, we're just shy of 800 now.
Just shy of 800.
Yeah.
Okay. And how long have you been at it?
Just 2 years.
Just 2 years. Interesting. What were the first few conversations like with that? Hey, we're about to get this going. Are you in?
Oh, wow. Yeah, that was nuts. Which with the institutions or the PMs?
Well, just you with the customers, the PMs. Like, I mean,
yeah.
Did you have people asking you for it? Hey, we want to invest in the U.S.?
Yeah. So originally we were like buying these homes and then selling them once they're turnkey with tenants in place. And then now it was interesting because that was pre-interest rate hikes, and we were selling them, and we were just like, hey, look, you can get U.S. real estate for $250,000, and it's the equivalent of like a Richmond Hill home, and you can be a landlord without being a landlord. So it was like a big, long sales job, right? And then interest rates went up, and yeah, it was just more of like be a landlord without being a landlord, and get it at a fraction of the price. You can buy in Ontario for $1 million, or you can buy for $250,000 and be cash flow positive.
Yeah. That's huge. Just being able to be cash flow positive. I mean, obviously you got to come in with a bit of money there, but once the refi happens, you can get that cash on cash looking a bit better, and then hopefully gets better and better as the rents go up and all that.
And there's a huge disparity in risk in a property in the Sun Belt. There's no basement. It doesn't go below zero, so your pipes don't freeze, right? Like for me as an investor here locally, my first thing to do when I'm in a property is go look at the basement. I'm looking for all the risks. Yeah. Right. Water damage, busted foundations.
So you're staying away from the hurricane states.
Oh yeah.
Staying away from basements if you can.
Because I think all investors should take that approach. Because I started from top down. I asked, as playing with ChatGPT, where should I be looking for investments based on these criteria, right? Assume I'm Warren Buffett, for example. Where would Warren Buffett be investing, right? Assume I'm Peter Zeihan, right? Where should I be looking for residential real estate investing?
Yeah.
Right. And so then that highlighted almost all the exact same cities that Share is already operating.
Yeah.
Right. So I'm getting multiple levels of confirmation.
Yeah.
Our mutual friend Hussein owns a lot of property in the States too. So he's another level of confirmation.
Yeah. And we'll never know every property he owns. It just comes up casually. Hey, I'm looking at something in this state. Oh yeah, we got one there.
not just one.
He's got a story for almost every state you could mention. Very interesting guy. He's been on the podcast a few times for those who want to check out those episodes. Hussein Kudrati.
And he told me you gotta go look at Memphis, Tennessee. I'm like, okay, Andrew's gonna figure out a road trip to Memphis, Tennessee.
Well, that'd be a great place to just visit in general. But I mean, Tennessee, like people sing its praises from a landlord friendly standpoint. Interestingly, I had a data guy on the show, and he said he doesn't like Nashville right now. Didn't say not in general. He just said because there's so many new units coming to market right now, the supply is going to be too much, and it's going to affect the appreciation potential.
Yeah, it's like Nashville's like your prime area, so like that's a very expensive area.
It's an expensive area already, and it's got a lot of new inventory coming.
So that is.
I think it's generally common among almost all the Sunbelt states that we've been talking about is that the multifamily they're quite overbuilt. It seems. Yeah, but it'll catch up. So
it's all based on when they're coming. Like, so he's paying attention to when the units will be ready. And I mean, like you're saying, like some of those it might be like 2027 where they're going to be ready. He said, so a place like Nashville, he said, don't get into it until after 2025. I just found that interesting. That's something I got to dig into a bit more.
Like Nashville, we wouldn't touch Nashville because like
just the price point won't work.
It's way too high. Yeah,
that makes sense. Yeah, so fair. So you're just going after, like, what's your max price point across all of it?
400,000.
400. Yeah. So that'd be more like Houston prices or something.
No, you get Dallas
prices.
Yeah,
too.
And then like in Atlanta, 400,000 would get you like a that premium like Oakville or Richmond Hill home.
I'm looking at suburbs of Atlanta. Suburbs of Austin for like 250, 300.
So you're thinking sell off the portfolio here, Erwin, and just sink the money into this kind of thing?
It's funny because when you introduced me, you're saying like you're all in. Like I wish I could sell everything here, but the tax implication, like to sell it all at once. But so I'll be slowly selling.
Yeah, that's true.
But again, like I think I don't, for my portfolio the way it is, the upside is not worth what I can do elsewhere. Yeah. I'm just frustrated.
Well, if you had to look at the return on equity, right? Like, what's your equity today, and how are you returning on that? And I don't think a lot of investors really look at that. And that's one of the things that drove me to just liquidate what I had in Florida. My return on equity was negative. So, okay, that's no good. There's no sense in crying over, values used to be up here and now they're down here. Well, what's my return on equity right now?
Yep.
If I don't plan to stay in long term, then might as well just exit.
Yeah. But I find most investors still need to understand what is in front of us long term.
Yeah.
Like pretty much every level of government's against us.
Yeah.
On the local level, I think 9 of our 12 city councilors are anti-landlord. Yeah. Our mayor is the former leader of the NDP.
You're referring to
specifically Hamilton.
Yeah.
But I've been in St. Catharines for a long time too. They're so anti-investor. It's not even funny.
Yeah.
Right. So again, I have all these headwinds against me,
Yeah.
My insurance is up $500 a house for my student rentals. Two of my properties in Hamilton, they fall under rental licensing, so that's another $600 a year. Sorry, that I cannot recoup. Right. So again, like the business case isn't there.
Mm-hmm.
Yeah.
Right. And like the running joke now I kind of have with people is like with an investor, like you had your spreadsheet was for 1 year. I tell investors, show me your pro forma for an Ontario property for 5 years, 10 years.
Yeah.
Because I know your expenses are going up, but you have rent control.
Yeah.
Right?
Unless you can get those tenants out, right? Or do some
What's that going to cost you?
or do some sort of other strategy. Yeah, exactly.
It's got to be other strategy.
Yeah, a more creative strategy. And they still are there. There still are approaches. And more sophisticated investors will do those.
I don't know. I was talking to John Schwenker today. I think I'm going to Ellicottville if I'm doing an Airbnb. I'm not staying in Ontario.
There are like... I mean, there's so many reasons to look at the U.S. Like you don't have to, but it's not that hard.
You don't have to. Like for example, if you're like a very active, your team is wonderful, you're great at flips, then that generally has to be closer, right? I get that, but again, then you're still talking about huge price points.
Yep. Right? You can flip at a distance. I'm always amazed at this, but you'll see this with Americans too. Like they'll invest all across the U.S.
Mm-hmm.
I'm like, oh, why not just own in your own backyard? Oh, we set up teams. I flew to the city once and we met a bunch of people and they just start doing it.
Yeah, out of state investing is more common than
Yeah.
sort of out of province or country.
Yeah.
Yeah.
The mentality of Americans, like in general, like their entrepreneurial spirit is just like, it just makes Canadians look.
I mean, if you look at all the laws for capitalism, it makes sense, right?
Yeah.
Like
it's a playground. If you wanna go into business and you wanna drive things forward, that's the place to do it.
it's easier to create that snowball.
I think so.
Yeah.
That's one of the things that attracted me to it down there. But I mean, for me, more than anything, like I think it just makes sense to have some stuff out of the country because it is a political hedge.
Mhm.
It's a hedge against what if Canada gets even more crazy than it is right now.
Yeah.
I would love to not have all my eggs in that basket.
Yeah.
And for me, I'd love to have more out of the basket than in it. And so that's sort of the mentality I've been having. Anything you would like to share that I didn't ask you today? Like I know I kind of just asked what was on my mind, but
I mean, I'm going to actually defer to Erwin on this one
Yeah.
because Erwin seemed like, so for context, majority of our clients were American and then about 70-30 and then 30 being Canadian. And recently and I know probably next to nothing as a real estate investor in Ontario.
yeah.
Which is hilarious.
Yeah, which is absolutely hilarious.
So our conversations were like we both look at each other like we have two heads.
Yeah. And like I learned all my Ontario real estate investing sort of best practices from just our short conversations. So after I met Erwin, he's like, you've got to, you expand in Canada and go after the Ontario landlord. So I'll ask Erwin, what do you feel we should be talking about?
I generally find, including myself, I was incredibly ignorant to what it was like to invest in the U.S. So, for example, when we went on a trip to Atlanta, I was talking to our property manager there. They manage 800 houses.
2,800 in that zip code.
I just forgot the digit 2. 2,800 houses just in Greater Atlanta.
Only single family.
Only single family.
That's
home.
crazy.
Yeah,
That's absolutely crazy because that scale doesn't exist in Canada. Like nobody does that across the country unless they're a major institution.
Yeah.
Right. Why is that? Why is that? So I think Canadians especially need to understand why is that. It's because just from my own research, because Americans aren't afraid of the tenants, versus listeners of the show who are Canadian are likely afraid of their tenants, or people who are on the fence.
Yeah.
They're like, tenants trash properties, they don't pay rent, blah blah blah.
Yeah.
And again, speaking to the American property managers, like your properties are like worth $1 million, and the tenants don't have to pay your rent,
Yeah.
and it can take you a year to get them out. Like they're looking at me like I'm crazy.
Yeah.
I'm like, oh god damn it, am I crazy?
Or that they have to pay property management
Canada's
fees.
crazy.
Yeah.
Yeah. Canada's crazy.
Oh, I said the property managers as well. Like in my experience, most property managers still charge here locally. They still charge if you're vacant.
Mhm.
Not the case in the States. That's culture. That's
Table, yeah.
It's
That's
just
standard.
That's the standard in the
Interesting.
States.
I've
Nope.
never paid vacant, but I've heard of people doing that. Is that common in Hamilton?
You don't even if you want to argue with someone, who else are you going to go to? Like
Yeah.
for example, you were a London investor.
Yeah.
I went to school in London,
Mhm.
and as long as I've been a real estate investor, There's no de facto property management company you want to use in London, Ontario.
Oh yeah, I will say like I bounced around from a few and ultimately ended up exiting from each one of them because they weren't satisfying what I was after. And then I ended up self-managing because I wasn't satisfied.
Because it's an impossible business to be in.
Yeah. Oh, it's a dog's breakfast to be a property manager in a place like that, because you know that all your landlords are going to be very razor thin profit, so they're going to be on you about your fees, and their expectations are going to be through the roof. Get me the highest rent. And I know, because I was the landlord that wanted the highest rent. You could have rented it out for more. It was part of why I ended up self-managing. Whereas you wouldn't necessarily need to do that in these cities because there's cash flow built in, it's there. And then when the rates go down, if they do go down, there could be even more cash flow in there.
Yep.
Yeah. So,
and then the alternative for a Canadian investor who wants something a little more boring, something that, something for the long term.
Yeah.
Like say even someone's a flipper here. I like my flipper friends, I say, like, if you go for your long-term investments, you probably want them here.
Yeah.
You can just do something easy, boring in the States. And if they're a share client, again, like kind of like the worst case scenario is you have a new tenant in 90 days. Right. If you have a bad tenant, you have a new paying tenant in 90 days.
Yeah.
Right.
That's a hell of a lot more palatable than a year, potentially. And the mentality is different, right? Like the tenants here, they know they have
all the rights. Yeah.
A lot of them, not the students though. Students are still gold, in my opinion, in my experience. But not down there in the States, right? They know you don't pay, you lose your house.
Yeah.
So they're gonna pay.
Yeah.
So, cool. Well, if somebody wants to know more, if they like, if they want to explore your process and what you have as an opportunity, what do they do?
They go to our website.
I'll just put it in the
yes, let's do that.
I think you sent it to me. So
create free accounts. You can look at some of our past and sample properties and play with the calculator and get a sense of type of homes. But that's not all of it. When we work with each client, we send them dedicated homes just that match their buy box, so no one else sees.
So I've booked a call with Dimitri now, who's Andrew's partner, he's chief investment officer. And again, so take a step back. Dimitri's worked on the team that assembled a portfolio of 20,000 units in Sunbelt states, right? For context, like Grant Cardone, who we can all appreciate is an expert in multifamily. Yeah, he manages, his assets under management is 12,000 units. 12,000 units. So Dimitri's worked on 20,000.
Yeah.
And Dimitri's been on boots on ground in all these cities. So I'm like, Dimitri, you tell me, where should I be buying?
Well, if you could set up a show with him, it might be good to just do like a pure data show, like have him on REI Hot Seat, and we'll just talk data and how the 100%.
He'd probably like that.
Yeah, he would love that.
Yeah.
He's bid against Grant Cardone on a few deals, so
that'd be super interested, and I think that would be a better fit for my YouTube show where we just dig into it. We could do some screen shares and stuff, and I'd love to do that.
Yeah. We've combed his NDA. I think we're good. So
all right, cool. So for anybody watching this, make sure you are subscribed to my REI Hot Seat channel as well, and you can catch that episode when it comes out. When we can set that up.
Yep.
We'll stay tuned. But thank you very much for doing this.
Thanks for having me.
Erwin, thanks for coming over yet again. We will keep it on a yearly schedule, I'm sure. And cool. We'll see you guys soon.
All right. Thank you.
And now a word from our sponsor, Control and Compound.
Infinite banking in under 60 seconds. We've all got to save our money somewhere, and we think that a high cash value life insurance policy is the perfect place to save it. Why? We're going to save our money inside this policy, and it's going to grow tax-free. Down the road, we're going to get hit with an emergency or an opportunity, maybe a chance to buy a business, real estate property, an income-producing asset, and instead of withdrawing from our savings account, we're going to leverage that asset. We're going to borrow the insurance company's money, and we're going to invest in that opportunity. Our money is still inside of that policy, compounding, uninterrupted, tax-free, and our money's outside in this investment opportunity. We're going to rinse and repeat, all while providing a death benefit for our families. Down the road, we're going to retire. Now we retire with a high cash value life insurance policy with a lot of cash. We're going to start taking those policy loans again, but this time we're never going to pay them back. When I say never, I mean we're going to pay them back with the death benefit when we die, and our families are going to get left with the rest completely tax-free.
For more information, visit www.controlandcompound.com/Andrew Hines.